Our guest in the last hour told us that right now it's a time to be perhaps preparing for more volatility and reducing risk. Is that a strategy you can subscribe to in this environment?
Yeah, look, I think when you look at the macro environment and certainly what caused the risk, in the fourth quarter of last year, none of that macro risk has really gone away. We just certainly saw it be heightened in the fourth quarter, and now, at the start of the new year, we've had a bit of a rally back in the equity market in particular. So, I think, we are going to be in for a bit more volatility this year. We haven't seen, global growth pick up. We have seen a bit better data come out of the US, but that's about all. Conversely, we've seen weakening data come out of Europe. So I think that's going to be an issue, and the real issue with monetary tightening and tighter conditions globally is still not going to go away either. So, and you just mentioned the Chinese trade discussions with the US. Those discussions don't have a conclusion, and it's unclear, what a conclusion would look like, even if they did sort of come to some agreement. So, I think volatility is going to persist this year. I don't necessarily think it's a reason to be too defensive, though. I think we have seen good earnings come out of the US. We have seen valuations become relatively attractive in Asia. And domestically here, we've got a bit of a mix of both there, where we've seen the market come down and valuations also become attractive. So I think the volatility this year should actually be an opportunity for investors to set themselves up probably for 2020 in good stocks which have suffered unfairly.
So talk to me about where some of that opportunity could potentially lie. Are you looking at equity in Asia, or are you moving towards a more international position now, namely the US or Europe?
Look, I still think the US looks attractive. It doesn't have the valuation attractiveness that say, Asia does, but the US, I think, economically should have strong drivers into the rest of the year. So definitely looking there, and you have seen a number of companies come down in price, particularly when you look at the discretionary sector. So, also Asia does look very attractive, I think, at the moment, although I think we're probably still a few months away from really allocating towards emerging markets at this stage. There's still a lot of uncertainty. We still, now that we've seen US interest rates come down, we can quite easily see a rebound to 3% and above there on the 10-year. The US dollar is still strong, and the trade uncertainty really does create an issue for a lot of the emerging markets. So I would be more defensive on emerging markets, but looking opportunistically in developed markets.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.